Welcome to Talk Tickers. If you are a regular listener, you know exactly what we usually do here. We live in the trenches of quarterly earnings calls.
Oh yeah, tearing apart guidance, scrutinizing operating margins.
We're looking for that one slip up from a CFO that completely changes a valuation model. We live for the micro. But today we are zooming out, way out.
We are putting the spreadsheets away for a minute to look at the playing field itself. Because in the sector we're discussing today, the biggest risk to your portfolio isn't a bad quarter or a missed earnings target. It's an existential question about what these assets actually are.
Exactly. Today, we're dissecting the regulatory framework of digital assets. And I want to be clear right off the bat, this isn't just, academic debating for law professors.
Not at all.
This distinction, is it a security, is it a commodity, or is it something else entirely? It determines everything. It determines who you answer to, whether it's the SEC or the CFTC. It determines your disclosure costs. And honestly, for a lot of the business models we see in crypto,
it determines if they can legally exist in the United States.
That's it. It's the ultimate macro factor.
We're talking about the difference between a compliant innovation and an illegal unregistered offering. The mission for this deep dive is to synthesize, decades of case law, recent court splits, and proposed legislation into a framework you can actually use.
A framework you can use when you're looking at a token or a protocol. So let's start with the bottom line. I'm a portfolio manager. I have to explain this to my investment committee who might be skeptical. Is there a simple binary switch here?
Security or none.
Yeah.
I wish it were that simple. The short answer is no, it is not binary. The classification falls on a spectrum, and it depends entirely on the economic reality of the transaction.
Economic reality.
Yeah, you can't just label something a utility token in your white paper and hope the SEC ignores you. The label doesn't matter, the mechanics do.
Okay, that sounds like a phrase that keeps lawyers very busy. Let's break down the current consensus before we get into the weeds. What's the safe ground? What do we know for sure?
The safest ground, the bedrock, is Bitcoin. Virtually every regulator, including the SEC and the CFTC, treats Bitcoin as a commodity.
Okay.
It's fungible, meaning one Bitcoin is the same as another. Its price is driven purely by supply and demand, and here's the key. It lacks a centralized issuer.
Right. If the price crashes, there's nobody to call to complain to.
Exactly. There's no CEO of Bitcoin you can subpoena. That decentralization is its regulatory shield. Now, jump to the other end of the spectrum. ICOs.
Initial coin offerings.
Right. If you're fundraising, selling a token to build a platform, and people are buying it hoping the price goes up because you do a good job, that's almost certainly a security.
That is the danger zone.
That is the danger zone. But the real headache for investors is the massive gray area in the middle. You have assets that are transitioning like Ethereum. You have yield products that look like savings accounts but operate like hedge funds.
Right.
And then you have the recent Ripple precedent, which basically said the token isn't a security, but the way you sold it might have been.
We are definitely going to spend time on Ripple because that ruling was a head scratcher for a lot of people. But we need to build the foundation first.
Yeah.
To understand why the SEC is suing crypto companies today, we have to go back to Florida in 1946.
The famous Orange Groves, SEC v. W.J. Howey Co.
I always find it funny that the cutting edge of digital finance, blockchains, cryptography, decentralized ledgers, is governed by a Supreme Court case about citrus fruit.
It is ironic, but the logic holds up surprisingly well. The Howey Test is the gold standard for identifying an investment contract. It has 4 prongs. If a transaction meets all 4, congratulations, you've issued a security.
Walk us through them. Let's say I'm launching Host Token. How do I fail the test?
Okay, let's apply it. Prong 1. Is there an investment of money? That's usually a yes. If you bought the token, you invested money.
Simple enough.
Although, there's an interesting nuance here with airdrops, free tokens given to users. Regulators have argued that even free tokens can satisfy this prong if the user had to promote the network or provide value to get them.
So free doesn't always free in the eyes of the law. If I have to retweet your announcement or join your Discord to get the token, I've invested something.
Precisely. You provided value. Prong 2 is common enterprise. This is where it gets technical. The courts look for horizontal commonality.
Which is?
The pooling of investor funds. We're all putting money into the same pot to build the network. Or vertical commonality, where my fortune as an investor is tied to your success as the promoter.
And in almost every crypto project, you have one or both of these.
Almost always. Okay, so money is invested, and we're all in the same boat. That covers the first two.
Right.
Prong 3, a reasonable expectation of profits. This is the marketing check. Did the team tweet to the moon? Did they promise ROI?
I feel like looking at any crypto Twitter feed satisfies prong 3 instantly.
It usually does. Marketing teams are often the ones who accidentally classify their token as a security just by being too enthusiastic, but prong 4 is the kill switch. This is the one everyone fights over.
Derived primarily from the efforts of others.
Exactly. This is the active participant concept. It is the pivot point.
Okay.
If I buy a stock, I'm relying on the management team's efforts to drive value. If I buy Amazon, I'm betting on the executives at Amazon. But if I buy Bitcoin, who am I relying on?
The code. The market, the miners.
Right. There's no specific active participant or AP whose managerial efforts are essential.
So if you can remove the active participant, you break the Howey Test.
That's the theory. If the network is truly decentralized, there's no other whose efforts you're relying on. And that pushes you out of the SEC's jurisdiction and over to the CFTC.
The Commodity Futures Trading Commission.
Yep.
Which brings us to the definition of a commodity. When I think commodities, I think pork bellies, corn, oil, physical stuff. How does a digital code fit there?
Well, the definition focuses on basic goods that are interchangeable in commerce. The CFTC views virtual currencies like commodities because, like gold or wheat, they aren't dependent on a specific manufacturer's ongoing management to retain value.
Okay, so a bar of gold is valuable because the market says so, not because the gold mine CEO is doing a great job.
Exactly. So for the listener holding a bag of altcoins, how do they spot this active participant risk? What are the telltale signs that the SEC is watching?
Good question.
You look for control. Does the project team control code updates? Do they hold a massive percentage of the token supply? Do they burn tokens, destroy them to artificially prop up the price?
Like a central bank buying back its own currency.
Exactly like that. If there's a central team pulling levers to manipulate the economy of the token, they are an active participant. And if you're betting on their ability to pull those levers correctly, you're holding a security.
This leads to a really fascinating concept, the Hinman transition. It sounds like a spy novel maneuver, but it's actually a regulatory theory.
It is, yeah. It's named after William Hinman, a former SEC director. In 2018, he gave a speech suggesting that an asset could start as a security and become a commodity.
Like a caterpillar turning into a butterfly.
Or a rocket shedding its boosters. Think about it. When a crypto project launches, it's centralized. You have a team, a roadmap, fundraising. It looks just like a security.
Sure.
But the theory is, if that team eventually steps away and the network becomes self-sustaining and decentralized, the active participant disappears. The rocket reaches orbit.
And at that point, the efforts of others, prong of Howey, falls away.
Exactly. It's a compelling theory, and it's what a lot of projects like Ethereum have relied on. But keep in mind, this is guidance, not strict law. The SEC has been, well, let's just say inconsistent in how they apply it.
Okay, so that covers the tokens themselves, the equity-like instruments.
Yeah.
But we need to pivot to the other side of the market.
Yeah.
The earn products. Staking, lending, yield farming.
Right.
I see ads all the time offering 8%, 10% APY. That doesn't feel like buying an orange grove. That feels like a bank account.
And that is exactly the problem. When you get into debt-like products, give us your crypto, we promise to pay you interest. Howey steps aside. Now we are dealing with the Reeves test.
I feel like Howey gets all the headlines, but Reeves is the silent killer for these business models. How is it different?
So Howey is for investment contracts. Reeves is for notes debt-like stuff. The Reeves test starts with a very dangerous presumption. It presumes that any note is a security.
Guilty until proven innocent. Ouch.
Basically, you have to prove the note bears a family resemblance to a list of non-securities. Things like a home mortgage, a consumer loan, or a secured lien.
So if I'm Gemini or Coinbase offering an earned product, I'm trying to argue, hey, this is just like a consumer loan. It is not a security.
Right. And the courts use 4 factors to judge that. The first is motivation. Is the purpose to raise capital for the business? If yes, it's likely a security.
Well, in most yield programs, the company takes your crypto and lends it out to make money. That sounds like raising capital to me.
It does. The second factor is plan of distribution. Is it offered to a broad segment of the public?
Download the app, click twice, start earning.
That is broad distribution. If it's available to millions of retail investors, the court says this needs protection. The third factor is public expectation. How is it marketed?
Ah.
If you use words like yield, APY, or passive income, the public expects it to behave like an investment.
It's interesting how the marketing team can just, get the legal team in so much trouble.
They often do. And the fourth factor is the most ironic. Risk reducers. The court asks, is there another regulatory scheme that reduces the risk for the investor? For a bank account, you have FDIC insurance.
For a mortgage, you have banking laws. And for a crypto yield account,
You usually have nothing. No insurance, no backstop. And the court's logic is, because there is no other safety net, we must classify it as a security so that the securities laws become the safety net of last resort.
that is a catch-22. Because you're unregulated, we have to regulate you.
Exactly. That is why we've seen the SEC crack down so hard on Kraken, Gemini, and others over these staking programs. Under Reeves, they almost always look like securities.
Let's shift gears to the courtroom drama. SEC v. Ripple Labs. This was positioned as the heavyweight fight of the decade. The industry was praying for a knockout blow against the SEC. Did they get it?
They got a split decision, but it was a fascinating one. The court made a distinction that surprised a lot of legal experts. They separated the token from the transaction.
Which means?
The judge ruled that the XRP token itself is just code. It's not a security, just like an orange grove isn't a security. It's how you sell it that matters.
Okay, so break down the two ways they sold it, because this is where the nuance gets wild.
First, you had institutional sales. Ripple sold XRP directly to hedge funds and VCs via written contracts. The court said, these are sophisticated buyers.
Right.
They bought from Ripple, they knew the money was going to Ripple, and they expected Ripple to use that money to build the ecosystem.
That checks all the Howey boxes. Horizontal commonality, expectation of profit from the efforts of others.
Correct. So institutional sales, securities. But then the court looked at programmatic sales.
The ones on public exchanges, Coinbase, Binance, that kind of thing.
Exactly. These are blind buy-to-ask algorithms.
Right. If I buy XRP on Coinbase, I don't know who I'm buying from. It could be Ripple, it could be a hedge fund, or it could be a guy named Dave in Ohio.
Sorry, Dave. But yes, that is the point. Because the buyer didn't know they were paying Ripple, the court argued they couldn't possibly be relying on Ripple's specific managerial efforts in that specific transaction.
They were just relying on market trends. That feels like a loophole. If I don't know it's you, it's not an investment contract.
It's a razor-thin distinction. But the logic is that an investment contract requires a meeting of the minds. In a blind algorithm, there is no meeting. So programmatic sales, not securities.
That is huge for the exchanges. It basically validates the model of listing tokens for retail trading.
It does, and that's why the price of XRP spiked when the news broke. It also clarified other distributions. Ripple paid employees and vendors in XRP. The court said these weren't securities because there was no investment of money.
You can't have an investment contract if no cash changed hands.
Exactly. So paying your staff in tokens is safer than selling tokens to VCs.
Legally speaking, yes. But the SEC is appealing parts of this, right?
Oh, yeah. This isn't settled law yet, but it is the current precedent.
So we have Howey from the 40s, Reeves for debt, and Ripple for exchanges. It is a patchwork quilt.
Yeah.
Is there any actual legislation coming to clean this mess up? Or are we stuck with court rulings?
There is movement. We're looking at bills like HR 3633. The goal there is to codify the things we've been guessing at. For example, they want to create a statutory definition for a digital commodity.
And how do they define it?
They use the term mature blockchain system. This attempts to legislate the Hinman transition. It defines a decentralized network as one not controlled by any person or group with unilateral authority.
So if a system meets that standard, the asset is a commodity, period.
That's the idea. It would be a game changer. It would solve the efforts of others debate once and for all. It also suggests that end user distributions, things like mining rewards, staking rewards, airdrops, should definitively not be treated as securities offerings.
That sounds great on paper. But as we legislate decentralization, the market keeps inventing new ways to complicate it. I want to talk about the governance risks section. This part actually scared me a little bit.
Yeah, this is where the code is law philosophy runs into the real world. We assume decentralized means safe from control, but look at economic DAOs, decentralized autonomous organizations.
They're governed by token votes. One token, one vote.
That was fair.
In theory. But in traditional finance, buying votes is hard. In crypto, it's just a transaction. This introduces the risk of empty voting.
Explain that. How can you vote without skin in the game?
Imagine you're a hedge fund and you have a massive short position on a specific protocol. You want it to fail. You can go to a lending market, borrow a massive amount of governance tokens for a small fee.
Use them to vote for a terrible proposal that ruins the project, and then return the tokens.
That is diabolical. You don't even own the asset. You just rented the voting power to sabotage the company.
Exactly. You have zero economic exposure to the downside of the token, but you control its fate. This creates what academics call contestable control. If control of a decentralized network can be bought or rented in a flash auction, is it really decentralized?
That brings us right back to Howey. If I can buy the network for a day, I am the active participant.
And everyone else is relying on your efforts, or in this case, your sabotage. This is why the decentralized defense is getting harder to prove.
It seems like every time the regulators catch up, the market moves the goalposts.
That is the nature of innovation, but it always comes back to economic reality. We can invent new acronyms, DAOs, NFTs, DeFi, but we can't invent new economics. Risk is risk. Reliance is reliance.
So let's wrap this up with actionable advice. We have listeners who might be holding these assets, or maybe they're analyzing equity in companies building in this space. When they look at a project, what is the one question they need to ask to assess regulatory risk?
The one question is this: does the asset's value depend on the managerial efforts of an identifiable active participant to survive and grow? Or is it derived from the programmatic functioning of a decentralized, mature network?
Why is that specific distinction the most important thing?
Because that answer determines liquidity risk. If it's a security, it gets delisted from major exchanges. It determines liquidity, it determines legal liability, and ultimately it determines if the project has a future in the U.S. market.
If you can't answer that question, you don't understand the risk in your portfolio.
Exactly.
There you have it. We have navigated the orange groves of Florida, the yield promises of the lending markets, and the blind algorithms of the exchanges. It's a complex landscape, but understanding the rules of the road, even if the road is still being paved, is the only way to drive safely.
Absolutely. And remember, in this industry, the rules are being written in real time. Stay watching the court dockets, not just the price charts.
A quick reminder that this summary is for informational purposes only. We're analyzing sources, not giving legal or investment advice.
Do your own due diligence, always.
Thank you for listening to this deep dive on Talk Tickers. We will see you next time.